Welcome to Mortgage Minutes, where we demystify the loan process for you. I'm your host, Austin Baker, along with my matchy co-host, Jonathan Mugg. Woo!
Looking fresh today, man.
Hey, I was trying to just, feel the rhythm.
There we go. So today we're going to be talking about why do points exist? And before we get into that, we're going to talk about what are discount points. And if you ever see me or on the phone with me, I love to talk about discount points. The reason why is because it saves our borrowers money and it allows them to buy their interest rate below the market rate. Now, it might not always make financial sense for every borrower, so we got to look at the total financial picture. But it's a way to save you money, to get your rate down and get your payments down. And if it makes sense, then we move forward. But today's video, we're going to be talking about why do they exist, Austin?
Yeah, so one of the big pushbacks we get from our clients is thinking that we're making more or we're somehow incentivized by offering discount points. If you're curious about how we get paid, we actually shot a video for you to check. So go check that out. We'll try to tie that to this video.
How we get paid.
But in that video, what we walk you through is we get actually paid the same way on every loan. It makes no difference to us what rate you go with. And that's because of fair lending laws. We cannot be, compensated higher because we got you into a higher interest rate or paid more because you paid points. And that's what we want to show you in this video. So this is all about the reason these fair lending laws exist is because, one, we're in a fiduciary role. Like our job is to help you get in the best financial structure possible. Well, if we're incentivized by what rate you're getting, that's not being fiduciary. And so I'm actually a fan of a lot of the fair lending laws because it really puts you as the borrower in the driver's seat in regard to how your financing is set up.
Yep, love that. So what's this look like, Austin?
Yeah, so let's just pretend this is where the rates are for you right now. And for your file, when we talk about a par rate, that's the rate that's coming up with no discount points and no lender credits. It's just everything is just the regular fees, and then what rate am I getting with that? And this is what a lot of people call us going, I don't want to pay any points, I don't want any credits, I just want the par rate. We've got a whole nother video for you if that's you, because every situation is different, and sometimes it is so cheap for you to get down here that you'd be a fool to just take the par rate. Sometimes it's too expensive, and you'd be a fool to get down to it. So everything is different. But for this, let's assume that this is par.
Man, that looks good though. 3%, baby.
Oh, I want it.
I want that.
I like that lower rate. So you
That's
say,
awesome.
Hey, cool, I know that rates are as low as 3%. Can I get that rate in this situation? Yes, you can. But what's going to happen when we sell this loan, Jonathan? When we sell this to the investor, if we put the borrower at 3%, how much are they going to pay us?
I mean, a lot less.
A lot less.
A lot less.
And that's the problem. So we've got to maintain our margin because we have to get compensated the same way on each loan. And so if we deliver them a loan at 3, but they said that they wanted to buy it at 3.5, that's an issue. We're not going to make as much money. Let's take the opposite. What happens though if we deliver the loan to them up here at 4%?
They'll make a lot more money.
They're going to make more money, so they pay us more money, but we can't keep that money. We have to take the extra overage that they give us for this guy, and we've got to pass that back to you. So if you get into a higher interest rate than where the par rate is for you, then we're not making more money. We can't make more money. We have to pass that back to you in the form of a lender credit, which is going to help offset your closing costs.
Exactly.
So we get paid the same at 4 and at 3.5. We also have to get paid the same at 3.5 versus 3. So here, your closing costs are going to be a lot more. And we know the cost of these things from the investors at the point when we're locking in your interest rate. So when we go to lock in your interest rate, they give us the pricing, and we know exactly how much it's going to cost or how much it's going to credit you to move in either direction from your par interest rate. So that's the main point of the video, is that we cannot make more or less based off of your interest rates. So what that means is you either pay less or pay more to get the rate that you want.
Yeah, so the way I look at it is, with the fair lending laws, we have to make the same margin on every loan. If not, it's discriminatory practices. We could lose our license. Network funding could lose their license. And so we have to make the same margin on all of these. So if you're going higher, we're putting money in your pocket. If you're going lower, money's coming out of your pocket.
Right.
And that's what we're here for, to make that decision with you, to help advise you on that decision.
Yep. So check out the other video on discount points where we walk through how we think about whether or not it makes sense for you. It's all about the return on the investment.
That's right.
All right.
See you
Stay
guys.
safe. Adios.